Yo, what's up, everybody? So I've made this video for you. Well, it is kind of delayed because I had a lot of stuff to do. And if you want to be like up to date, because as you can see, this is July 3rd. It's 4th August, so it's really delayed. But I will still upload it. And if you want to just keep up to date and just be updated, like as soon as stuff happens, just join my Discord. This was update. I posted about this there like straight when it happened. So yeah, if you want to be too up to date, just join the Discord and just be active, and you'll know. So let's start with the opening. Uh, if you're watching this, you already know the Fed held rates. Yesterday, as you can see, it's late, so not yesterday, but a couple days ago. But if you think this was a boring meeting, you're wrong. This was the most consequent. These are words, sorry. FOMC since 2022, and the market direction tells us something the headlines are completely missing. 3 cents, long end yields at 2007 highs, the dollar down, equities down, break-evens up. That is not normal hold. That is a market saying we don't believe you. Let me walk you through exactly what happened, what the banks are saying, and most importantly, how to trade it. Let's start with the facts. The Fed kept rates at 3.5 to 3.75%. That was expected. What wasn't? 3 cents, Hamek from Cleveland, Kashkari from Minneapolis, Logan from Dallas. All three voted for 25 basis point hike, the most dissent since 2022. MUFG, MUFG, however you spell it. Sorry about that. Call it a family fight. I just tryna read fast so it's not like 20 minutes long video. Free dissent from a 12-member committee doesn't mean the Fed is about to hike, but it does mean the committee is fractured. And fractured committees create uncertainty. The real story wasn't the vote, it was the press conference. Ward spoke for 45 minutes. ING called it somewhat confusing. MUFG said it was lacking a clear anchor for inflation. SAB called it more fragmented and difficult to interpret, which it was actually. Yeah, I would agree with like it was confusing and difficult to interpret. Walsh was asked repeatedly why didn't you hike. He couldn't give a straight answer. He said the market may have done some of the work, but he never said what would make them hike or cut. That's not for guidance. That's no guidance at all. Market reaction. Now the market reaction, because this is where things get interesting. The 2-year treasury yield fell 9 basis points. Makes sense, but the 10-year rose 7 basis points to 4.68%. The 30-year surged 10 basis points to 5.21%, the highest since 2007. The 2S 10 curve steepened 10 basis points, the biggest one-day move since August last year, and 5-year inflation break-even jumped 6 basis points. A normal hawkish hold looks like short and down, long and flat, inflation anchored, equities up, dollar up. That's not what we got. What we got: short and down, long and sharply up, inflation expectations spiking, equities down, dollar down. The market direction clearly reflected a Fed potentially going soft on inflation. Talk is cheap. The Fed has to eventually walk the talk on inflation. This is what bond vigilance looks like. In much what I said right here. Can go to Fed credibility because this is probably the most important. Now let's talk about what this means for the dollar. Scotiabank's fair value model for the XY based on 2-year yield spreads puts fair value in the mid 99s. Spot is at 193, so 100.93, so the dollar is about 1% above fair value, and that premium is partly geopolitical risk. Iran, the Middle East. ING's Chris Turner, the XY probably risks a correction back to 100.5. The two sets of CPI prints and jobs data before the September FOMC will determine whether the DXY has topped for the year. MFG, the Fed credibility is being questioned. And after a big jump in inflation expectations, the US dollar outlook has certainly worsened. Here's the key takeaway. The Fed has outsourced tightening to the market, Walsh basically said it himself. Yields have risen materially and the market may have done some of the work. That sounds clever, but it's a massive credibility risk. If the market doesn't believe the Fed will hike, it'll keep pushing the long end yields higher. Either the Fed hikes to restore credibility or inflation expectations de-anchor. Either way, the dollar is in a tough spot. Also, Bank of England. Now let's cross the Atlantic. The Bank of England held at 3.75% expected, but the vote was 6 to 3, tighter than 7 to 2 consensus. Catherine Mann joined Peel and Green in voting for a hike. But here's the key. Governor Bailey killed the idea of a September hike. He said it is not unreasonable to assume the Bank of England is edging towards a hike. And Lombardelli, who we thought might join the Hawks, said a hike wasn't a close judgment. MUFG's the bar for September hike looks a bit higher after today. Now the trade. The 2-year gilt is at 4.34%, 60 basis points above the bank rate of 3.75%. That prices is in roughly 2.5 hikes over the next 10 months. But MUFG sees diminishing inflation risk in the Bank of England's own language. Danske Bank sees the Bank of England on hold all year with a cut in 2027. So the market is pricing 60 basis points of hikes. The Bank of England is saying we're not even close. Something has to give, and that's something 0 GBP. MUFG targets 0.89. That's a trade in a market full of uncertainty. Now, I'll get back to this later. I'll just finish the stuff I have here. USD let's talk Japan. USD fell 3.5% yesterday on a heavy volume. That's intervention. ING estimates Japanese authorities sold around $70 billion over 2 to 3 days, matching the scale of the April campaign. The timing was perfect. The dollar was already soft after the Fed, then softer USPC data added more pressure. But here's the thing, intervention works short term, it does not change the macro trend. The move was well timed, but a lasting turnaround in USD will require the Fed not hiking in September and more hawkish Bank of Japan. The problem, the Bank of Japan is expected to hold tomorrow, which they did, and if they surprise with a hike, it won't close. They didn't. So, unless we get much softer US data or the Bank of Japan defies the government with a hawkish message, we suspect USD can grind back above 160 next week. This is a deep bang opportunity, not a trend reversal. I'll also come back to this because it got some more stuff. Hidden signals. Now let me tell you what the banks are implying, but not quite saying directly. First, Fed credibility is worse than the numbers suggest. And we are not so sure whether Walsh implicitly, holy shit, acknowledged that higher real rates embodied an expectation that the Fed would hike in September. Translation, nobody knows what the Fed is doing, and that is dollar negative. Second, the bond vigilance are back. ING bond vigilance could have a say if a sell-off in the long end accelerates and the Fed is forced to anchor the short end with a hike. If long end yields keep rising, the Fed will have to hike. Not to fight inflation directly, but to restore credibility. This is not a position you want to be in. Third, the Bank of England's inflation forecast is already stale. MUFG noted the Bank of England's forecasts use energy futures only up to July 20th. Energy has moved significantly since then. On current pricing, MUFG sees inflation peaking closer to 3.5%, not the Bank of England's 3.2%. If that's confirmed before September, the Bank of England will have to revise higher, and that could force a hike that Bailey is currently resisting. So, trades, now this is delayed as I said many times, but we can go over this and then I'll add my final thoughts. because some of the stuff already changed, and we'll finish that. Here's the trades with the highest conviction right now. They're not highest conviction. Trade one long your GBP and trade on blah 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 blah. The market is pricing 60 basis points of Bank of England hikes. The Bank of England is saying extended hold. Something has to give. MUFG targets 0.89. Energy has opened 86 as an immediate target. Risk energy spike forces Bank of England's hand. Now this could go both ways. Energy spike could also force Europe hand, but both will be like stagflation, I think it's called, or stagnation. I'm not sure. I think it's stagflation, yeah. And that's just bad yield and could be a policy error and like it's just bad hike. It's not the type of hike that will attract investors. So it's like hiking into bad economy, since it's just because of oil. Then trade to buy USDJ2 and dips, entry blah blah blah, target blah blah blah, intervention is temporary, the policy gap is risk used at the softens and is Fed pills. Okay, so on this, actually I did try to fade it or like going long, but I thought this was like just a basic intervention try to intervene like they tried many times. It was just a deep buying opportunity, right? But this time there was actually a US Treasury, something them saying they will also intervene to support yen. Yeah, right here. US Treasury intervenes to support yen after Japan steps in. Holy shit, I just gotta pay for everything. Okay. To support yen making the first direct US currency intervention since 2011, this action countered this sudden market movements after the yen hit 40-year lows, mean near 164 per dollar. So this is probably stronger intervention than these tips were. So I won't be looking to really buy it as a dip. I'll give it some time to, you know, do what it has to do, and then we'll see. It's definitely after macro takes over, it's definitely buy. And then trade free short gold on release entry, blah 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 blah. Long can yields are rising, real yields are not falling, break-evens are rising. Scotiabank, the macro backdrop is not yet unambiguously favorable. Risks of VPC, Fed credibility collapse and meet is escalation. Yeah, so I'm not sure about gold. I wasn't really looking at gold for quite some time now. I can it's consolidating right now. We wouldn't trade it really. But if you want to short it, I would wait for macro to take over again, and then it will be a much better short, in my opinion. Since now there's credibility questions and stuff like that about the Fed, so that's negative for the US dollar. Trade for, I don't even trade this pair. This is just from the bank reports. You can read it if you want, but I don't trade this. The key takeaway from all of this: the Fed is not as credible as the market thought. Wash okay, I'm not even gonna read this because I can't right now. Guidance has created uncertainty. The bond market is pushing back. The dollar is vulnerable, but September is still a live meeting, and energy prices could force everyone's hand. Stay nimble, watch the data, trade what the market is telling you, not what you want to believe. So also I did it here. I added short your USD and or your GBP since both could be hawkish, but it's just bad hawkish, or how would I explain? Like it's not like they have data behind it to back the hawkishness. It's just that energy is pushing them because of the inflation in of oil, and pretty much USD doesn't have that. They have like good economic to good growth, not like GBP and Euro. They have bad growth, bad economy. So that is cleanest trades to take. After wait for macro to take over again. And target, I didn't really look at price, but I just said lows. Then we have longer GP, but they just want the bank reports. This. And what did I? Bank of England, yeah, there was a risk of repricing Dovish, which I think they did. And we can. Price is not really saying that, but I think I think they did say like don't expect a hike at the end of the meeting, so that might be repricing dovish. And yeah, I think I went over that here. Fed credibility, that is the most important right now, in my opinion. And yeah, that's I think I went over everything. If you have any questions, you can just join my Discord. It's in the description, and just ask in the chat. It's free, and I will respond within, I don't know, it will be quick. So yeah, see you next time.